Sticky inflation in Britain has dashed mid-year rate cut hopes. Strong domestic inflation in New Zealand looks concerning for its central bank. The ECB looks on track to start rate cuts in June. And the oil price is down 3%. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ's head of FX research, Mahjabeen Zaman, looks at why the US dollar has been so strong.
Fed shifting from, at the start of the year being possibly the first bank to ease rates is now moving down the order to maybe being the third, fourth or fifth.
But first in 5 and 5 with ANZ. US stock markets fell overnight after some soft earnings reports. The S&P 500 down 0.2% at 4 a.m. Sydney-Melbourne time. The Nasdaq down 0.6%. The yields on US Treasuries fell, though, the 10-year down 8 basis points, and the US dollar index was down 0.2%. The Aussie dollar up 0.6% at 64.39 US cents, and the Kiwi up 0.7% at 59.18. Oil was the big mover overnight, down nearly 3%, as fears around global demand outweighed ongoing worries the Middle Eastern conflict will widen. In the UK, sticky services inflation saw markets pare back hopes for a mid-year rate cut. Headline annual inflation was 3.2% in March, down from 3.4% in February, but it was above expectations. ANZ economist Bunzi Madhavani says the real worry is slow progress on services inflation, which is running at an annual rate of 6%.
A few months of disinflation trend on services front is necessary for the Bank of England to gain that extra confidence to cut rates, and we think that will materialize by August meeting. Market pricing is broadly aligned with our view. After the data release, markets pared down the odds of an early rate cut and are now pricing in first full rate cut by September.
Number 2. New Zealand's annual inflation in March came in at 4%, down from 4.7% in December. That was slightly above the Reserve Bank's forecast. But as ANZ economist Henry Russell explains, continued strength in non-tradables or domestic inflation at 5.8% annually is what should worry the central bank. It had been forecasting at 5.3%.
Domestic inflation pressures remain very acute. And on the core measures of inflation, which we had expected to take a meaningful step down, we didn't see the extent of progress we were looking for. And so for the Reserve Bank's perspective, what these data speak to today is that domestic inflation pressures continue to ease more gradually than they'd anticipated when they went on hold last year. Q1 marked the 4th consecutive upward surprise on non-tradables inflation.
Number 3. It's a different inflation story in Europe, though. Final euro area CPI estimates for March showed progress on headline and core inflation. Headline annual CPI inflation was 2.4%, down from 2.6% in February. Bunzi says this is positive for the European Central Bank.
The downtrend in all measures of inflation will give confidence to the ECB that 2% inflation target is not just within reach, it also may be sustainable. Now, the ECB will get April and May inflation data before it meets in June. Were that to confirm that disinflation remains on track, which is certainly our thinking, the ECB will be geared up to cut rates in its June meeting.
Number 4. Japan's exports rose for the 4th month in a row in March, up 7.3% year on year. ANZ head of FX research Mahjabeen Zaman points to strength in car and chip exports.
That's thanks to the weaker yen that's providing a tailwind for Japanese exports. And also what we have seen is that demand in China is picking up, so giving the economy a much needed boost. Broadly, the direction for the trade deficit in Japan is moving in the right direction as the trade deficit has been narrowing since last year.
Number 5. Australian jobs data is out later today. ANZ senior economist Blair Chapman sees the unemployment rate rising to 3.8% and jobs growth of 25,000. He says the Reserve Bank of Australia will be hoping employment won't be as strong as last month.
The labour market's been pretty wild recently, and we saw a massive increase of 116.5 thousand in February, and there is people out in the market expecting a big pullback this month. So the range out there in the market's from negative 40,000 to up 30,000. So we're a bit more on the upbeat and positive side of the market.
Blair Chapman there. Now, in today's bonus deep dive interview, ANZ Head of FX Research, Mahjabeen Zaman, says there's 4 key drivers to the US dollar's strength in recent weeks.
There are a host of things that are moving in favor of US dollar strength. First of all, we think that in the very short term, definitely the US dollar bulls are in play at the moment. And I think the few factors that are driving this, first and foremost, is safe haven demand. I think, with the ongoing geopolitical tensions, in terms of safe haven currencies, you tend to have the US dollar, Japanese yen, and Swiss franc as your traditional safe haven currencies. We know that dollar yen has only been getting weaker and weaker, possibly keep that one excluded. Then we look at Swiss franc. We know that the SNB, the Swiss National Bank, has already started its easing cycle. And so we have seen a weaker Swiss franc as well. And so it really leaves us with the US dollar that seems to be benefiting from the safe haven demand. And that has lent support to dollar strength. On the other side of it, we also see a lot of central bank divergence. We have seen speakers from the ECB continue to point to possible cut in June. This surely looks to be priced in to be ahead of the Federal Reserve, which is now market pricing is looking at possibly a September or a November start. And so again, Fed shifting from, at the start of the year being possibly the first bank to ease rates is now moving down the order to maybe being the third, fourth or fifth. And obviously that depends on UK CPI we get today, how that pans out. And of course we had Canadian CPI yesterday, which was also much lower than expected, which then points to the view that, Canada might ease sooner rather than later.
So could you tell us how the Chinese yuan fix has thrown Asian currency markets around a bit?
Yes, so the yuan was allowed to weaken further, and clearly as a result of that, we have seen sharp moves in broad Asian FX. And again, weakness in the Asian FX area has surely been providing support to the US dollar. When we look at Australian dollar as well, Australian dollar tends to be most correlated to shifts in the CNH. And clearly that has also led to Aussie dollar establishing new year-to-date lows. And it looks like the pressure for now remains on the softer side for the Aussie.
And then sitting above this, we've got solid economic data coming out of the US.
Exactly right. I mean, US exceptionalism is not fading. We do get Q1 GDP numbers next week. Consensus expectation is around that 2% mark. But, when we look at other indicators like the Atlanta Fed GDP now number, that's standing at 2.9%. And so, again, long-term growth numbers for the US really stand at 1.8%. So, again, I think US exceptionalism, as we saw in the retail sales numbers earlier this week, seem to be in play. And again, that supported the USD for now.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, April the 18th. Catch you tomorrow with Australian jobs numbers detail and what it could mean for the RBA. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.